everyone. Jason Gordon, residential mortgage specialist. Today's deep dive topic will discuss mortgage interest rate buy-down strategies and how these strategies are so timely in the current market here in the fourth quarter of 2022, and specifically how they are helping home buyers save money on their monthly payments when they're buying a home, while simultaneously helping home sellers maximize their profits when they're selling a home. And of course, if you are a real estate agent, I heavily encourage you to understand these topics and to share this information with your colleagues. It is essential to know these strategies exist, especially in the current market. So today's presentation agenda will be short and sweet and very informal. I will start with reviewing some recent statistics in terms of mortgage rates and how they have impacted the housing market. We will also discuss that there are two different types of buy-down strategies. Now, we live in a soundbite generation. We have these 30, 45, 60-second videos on social media, these reels, these stories. They're great to get attention. They are not great at fully understanding the concepts to the level that we need to understand as consumers or professionals when we're making these large decisions. So a lot of social media, these short videos are really making it sound like there's just one kind of buy down. That cannot be further from the truth. You'll see here we have temporary buy down strategies, which I like to call payment or interest rate subsidies. The key word here is temporary. There are two temporary buy downs. There's a 2-1 buy down and a 3-2-1 buy down. Today, I will focus on the 2-1 buy down just to keep it short and sweet. The other type of buy down strategy is a permanent buy down, where you are buying the interest rate down for the full term of that loan. And of course, as we all know, there are different terms out there. Today, I will use a 30-year term in my examples. And again, as I go through these numbers, you'll see how these strategies are going to benefit buyers, sellers, and real estate agents as a whole. Now, to keep my compliance officers happy, a couple of bullet points here. I'll go over them really quickly. This is all done for educational purposes solely. There are no legal or tax advice concepts being provided. This is not an offer to lend or a specific rate quote. Any examples I give are just examples. I am an equal housing lender, and my NMLS ID is 259027. All right, let's get to the fun stuff now, shall we? Mortgage rates. We all know mortgage rates are constantly moving. When you're borrowing money, it's real simple. You want the lowest rate possible because that creates the lowest monthly payment and the lowest amount of finance charges you're paying to borrow that money. Of course, sometimes we have higher rates, sometimes we have lower rates. This chart here shows the last 50 years. We can see the trends. If we look over here at the current market day, current market, we're at over 7%, which may seem very high if we're comparing rates today to where they were during the pandemic when they were in the twos. But if you look over the last 50 years, they're still pretty amazing. But I do understand, I quote rates daily. I understand that this recent trend of interest rates going up has dissuaded a lot of buyers. And I understand and I respect that. But let's talk about some economic principles here. There's a principle that says you want to buy when everyone's selling. You want to sell when everyone's buying, whether that's real estate, whether that's stocks. Let's talk about real estate here. And over the last couple of years, during that 2020, 2021, and even the first quarter of 2022, these global pandemic-related drops in mortgage interest rates encourage more people to come out and look to borrow money. So that created more home buyers in the market because they all wanted these rates in the 2s and in the 3s. What a great time if you are a homeowner looking to sell your property when there's this huge amount of buyers that have infiltrated the marketplace, because now, put on your home seller cap for a moment, you have 20, 30, 40 plus buyers trying to buy your home. Well, if you're the seller, you sit back and say, well, who wants my home the most? How much are you going to pay? How much are you going to pay? You have to give less, if at all, any concessions. A lot of home sellers weren't even doing repairs. They were selling the properties as is and enjoying the fact that these buyers were bidding up the price, kind of like going on eBay and just buyer is offering this much, this one's offering that much, higher and higher. At some point, that property sells. That sale creates what we call a comp in our industry, which is a comparable property sale. That comp on, let's say, property number one that just sold is then used as a baseline offer price for home number two that gets put on the market. So you can see over the last couple of years, this trend was great for sellers and really for a lot of buyers too, because you're borrowing money at 2, 3, maybe 4%. What a great low historical carrying cost of borrowing your money. Well, now we look at the trends that we've seen recently. Again, rates are not that high compared to the last 50 years, but they're a lot higher than they were during the pandemic. They've more than doubled. So a lot of buyers have slowed down and decided not to buy, at least as of now. This has created a leverage shift to the buyers that are still out there, because now a lot of sellers are looking to sell their home. They have less buyers vying to buy their home, and therefore a lot of sellers are making concessions. They're making repairs. They're dropping sales prices. All the while, the buyers are enjoying these benefits, but at the same time, they're taking a bit higher than market rate. But the rates that they're getting now, are they going to keep that rate for the next 30 years? I'm going to show you why I heavily doubt that's going to happen. If you look carefully at this chart, you'll see these vertical shaded areas that appear sporadically throughout the last 50 years. As it says right here where I'm circling, these indicate U.S. recessions. I want you to look carefully at what happens to rates during these shaded areas. They almost always drop. Nearly every economic advisor over the last year has been saying more or less the same thing, that a recession is imminent. As I'm recording this video in fourth quarter of 2022, some would say that we're already in a recession. Others would say that we have one due in the first or second quarter of 2023. So if you play out that concept and say you're buying a home now and you are competing with less buyers and getting more concessions from your seller, all the while under the thought process that the loan that you're getting now, we'll call that loan A when you're buying the property, is not going to be held for the full 30 years. You're going to refinance it into loan B, likely in the next year, give or take. So let's pause mortgage and real estate just for 30 seconds here. Clear our heads. Let's say you were opening a business. Let's say I was selling you a machine and I said to you, this machine is going to cost you $4,000 if you buy it from me. But if you buy it, your business will make $100 a month. Well, we can do the math in our head pretty quickly and say, well, I need to keep that machine for 40 months of making $100 in order to recoup my initial cost of $4,000. So the question would be, if you're that business owner, how long do I plan on keeping that machine? And that would help you dictate your answer as to whether that machine was a good purchase or a bad purchase. Now let's unpause and get back to mortgage and real estate. If you are getting loan A and that is your machine, yet you are forecasting that you're going to be buying a brand new machine in the next year, in this case, machine number B or letter B, you're going to keep your cost very low on A because you're not going to have it that long, right? So this is where the buy down strategies are really quite attractive. So let's look a little bit more carefully at an actual example here. Let's say we have a seller selling their home for $800,000. By the way, this is going to be a temporary solution, a temporary buy down solution. Sales price of $800,000, buyers putting 20% down, which is $160,000. Buyer is going to borrow the remaining $640,000. Let's just say, for example, that the going rate is 7.25%. Mathematically, that 7.25% on a 30-year term at a $640,000 loan amount will kick out what's called a P&I, which is principal and interest payment, of $4,365.93. By the way, these payments do not include property taxes or homeowners insurance or any HOA dues or Melrose assessments. This is just the P&I portion of the payment, which, by the way, is directly computed once we know the term, in this case 30 years, the loan amount, in this case 640,000, and the rates that we're showing on this example. So it's 7.25, payment is 4365.93. Now on this 2-1 buy down option, what happens is in year number one of this 30-year term, year number one, that rate is 2% below the note rate. If the note rate is 7.25, year number one, the buyer is paying at 5.25%. In this case, the payment, $3,534.10, which is a payment difference of $831.83. Year number two, it goes up to 1% above the start rate and 1% below the note rate, in this case, 6.25. Now the payment goes up to $3,940.59, which is still $425.34 less than the actual payment that will be occurring from years 3 through 30. What an interesting option for a buyer who is planning on keeping this loan for a short amount of time. Why walk into that 7.25 rate in payment when you can get 5.25 in year one, 6.25 in year two? And if you are keeping the loan less than that 3-year period, you just saved a ton of money. Now, the way this works is the seller has to provide this concession, this buy down amount. And the buy down amount is the difference or delta between the note rate payment and the year one and year two payments. So if you see on this chart here, that $831.83 saved in year number one multiplied by 12 months is a total amount of savings just shy of $10,000. In this case, $9,981.94. Year two, that $425.34 savings per month multiplied by 12 months creates an annual savings of $5,104.08. Now, there's specific verbiage on how we have to word this to be compliant with Fannie Mae, Freddie Mac underwriting guidelines. I do encourage you to contact me directly if you have any questions on how to properly word this. But in essence, and this has to be referenced properly on the purchase agreement if you're going to do this. But essentially, the sum total of that $9,981 and that $5,104 is $15,086.02. Now, the seller will take that out of their net proceeds and buy that money down. Now, here's what's interesting. A couple of things are interesting here. Number one, let's say that that buyer refinances loan A in 12 months. And let's just round off the numbers here. And we see the savings in the first 12 months. Let's just call it $10,000 for argument's sake. Let's say that the buyer was to refinance. There's still $5,100 that's unused in that seller concession when the buyer goes to refinance loan A. And let's say that loan amount was $640,000. Let's just say that the loan amount didn't change. It's $640,000 when they go to refinance. That $5,000 of unused money would be applied as a principal reduction. So when they pay off loan A year from now, the payoff is going to reflect $635,000. There's more details on payoffs, but that's the general concept. So that money doesn't just get wasted if the buyer was to refinance in those first 2 years. And how great is this for the seller? Okay, let's put on that seller cap for a moment. We talked about how great it was during the pandemic when everyone was trying to buy those homes. What happens if that seller just holds to the $800,000 sales price, doesn't offer any concessions, and the property just sits and it sits and it sits? The longer that property sits unpurchased, the higher the probability will be for the vultures to come out of the woodwork. When I say vultures, and I mean this respectfully, these real estate investors that say, hey, seller, you want $800,000. Well, nobody seems to be willing to pay that. We're going to offer you $700,000. And we may even try to sweeten the deal by calling that a cash offer. Well, cash offer or not, that seller just lost $100,000 on their net proceeds. In the example right here, clearly they walk away with a lot more money if they're only giving up $15,000 and holding that sales price at $800,000. And as a separate note here, and this may not be on the minds of a seller, but let's say that seller dropped the price from 800 to 700 just to push the property and get it sold. They created a lower comp in their area of 700,000. All those neighbors are not very happy right now that you just dropped their comp value down that much that quickly. So not that you're always caring about your seller or your neighbors when you're selling a house, but I inherently believe that people don't want to do bad things to other people. I hope that's the case, and more often than not, this is a great way to keep the comps high, keep the values nice and high, and for that seller to walk away with as little amount of a concession as possible and the highest amount of profits, while enticing that buyer to take advantage of these, of the forecasted lower interest rates in the near future. So this is an example of a 2-1 buy down. So now that we've gone over an example of a temporary mortgage interest rate buy down solution, let's pivot to a permanent mortgage interest rate buy down solution. And I'm going to show you entirely different numbers, an entirely different scenario. And I'll even use one of my spreadsheets that I prepare for my clients and for my real estate agent partners. So in this example here, I prepared this for a real estate agent partner of mine who was about to take a listing with the hope of selling that property for $1,725,000. That's the ideal sales price, $1.725 million. As an example, let's assume that the buyer puts down 20% and they finance the remaining 80% to create a loan amount of $1,380,000. As an example here, the quote of interest rates is at 7.125%, which creates an all-in what we call PITI payment. PITI is principal, interest, property taxes, and homeowners insurance. That entire PITI payment is estimated at $11,394.20. Now, ideally, that property sells full price right away. But what if it doesn't? What if it sits and sits and sits? Now out come the vultures. They see the property hasn't moved and they want to offer less. Let's say the seller entertains a significant price reduction in this third column. Let's say they drop the sales price by a full $100,000. Okay, instead of selling it for 1.725, they sell it for 1.625. As we all know, that's $100,000 less in the pockets of the sellers. As we discussed earlier, that's also a brand new comp for a much lower sales price. You're going to have some pretty angry neighbors. What does that actually do to entice the buyer in terms of cash flow? Well, at the 1.625 sales price, 80% of that sales price is $1,300,000. At that same 7.125 rate, we have a lower PITI payment, both in the P&I because we're borrowing $80,000 less, and the T, the property taxes, are based on a lower purchase price. In this case, the payment is now estimated at $10,751.05 for a difference in payment of $643.15. Well, let's take a look at that objectively. As a seller, you entice the buyer by saving them $643. That's real money. That might be an enticement. But what did you give up? You gave up $100,000 to do so. What if there was an option that you can keep more money as the seller, keep your baseline comp where it should be, and actually further entice the buyer with a bigger monthly payment savings? I direct your attention to the middle column. The sales price stayed at 1.725, which meant the loan amount stayed at 1.380. But now we had the seller invest in buying the interest rate down for the buyer. In this example, let's use 2 points or 2% of that loan amount of 1.380. That's a concession of $27,600. But look what it did to the interest rate. It went from 7.125 to 6.125. The PITI payment now dropped to 10,481.91. We didn't get that T break on the property taxes because the sales price stayed the same. But when you're borrowing $1.380 million and you drop 1% off the interest rate, you see a much more profound savings. In this case, over $912 a month in savings for the buyer. You held your price. And once you apply that $27,600 concession, the seller still nets an additional $72,400 more than they would if they pursued that option over here on the far right column. So again, these are examples of creative financing solutions. I heavily encourage you to be working with seasoned mortgage professionals as opposed to these inbound call center sales folks that just want to get your sale made. Look at creative financing solutions from folks that have done this for a long time, who are reputation based. I'd like to offer my services as consideration. The way to get hold of me is on the screen here. I'm Jason Gordon, residential mortgage specialist. My cell phone that you're welcome to call or text is 619-200-8031. My email address is jasongordonmortgage@gmail.com. My electronic business card can be found at vipborrower.com. vipborrower.com, you can actually download my e-card into your phone, have quick access to call, email, text me whenever you want, to access my social media, my online reviews, my mortgage calculators, even my loan application. So vipborrower.com is a great way to have me in your phone. I always say it's better to have me there and not need me than need me and not know how to get hold of me. I'm happy to work with you and or those whom you care about. I thank you very much for taking the time today, and please feel free to share this information with those who you think may benefit from it. Take care, folks. Thanks again.